Tonight, we drift into the quiet chambers where the world's money finds its rhythm, stepping softly into a central bank long after the bustle of the day has faded. The building seems to breathe in its own slow way, as though each stone has absorbed years of conversations about rates, reserves, and stability. A single lamp glows along a polished corridor, throwing a warm circle of light over the marble floor, and the hum of the city outside feels faint and distant. Here, decisions are never rushed, and nothing moves with sudden force. You walk deeper into the hall, your footsteps softened by thick carpet, and the air grows calmer, almost expectant. Papers lie neatly stacked on long wooden tables, their corners held down by small brass weights that glint under the lamps. On one page, you notice a simple number, a percentage written with careful handwriting. It is the kind of number that, when adjusted even slightly, changes the course of millions of lives. This is the central bank's policy rate, the quiet steering wheel of an entire economy. While the room feels almost ceremonial, the work that happens here is deeply practical. A central bank exists to keep the financial system stable, to guide inflation toward a gentle pace, and to ensure that credit flows steadily enough for households and businesses to plan their futures. It cannot dictate the choices of individuals, but it sets conditions that nudge everything in a particular direction. By raising or lowering its key interest rate, it influences how expensive it is to borrow, how rewarding it is to save, and how quickly money circulates. You pause beside a large clock, its hands moving with soft, deliberate ticks. A central bank's power is often misunderstood, partly because it works in long arcs rather than sudden leaps. When policymakers change a rate, mortgages do not shift instantly, and prices in grocery aisles continue their own slow dance. The effects spread through the economy like ripples across a calm pond, each one informing the next. Somewhere in the building, a late worker closes a file, and the sound echoes quietly. You imagine the layers of analysis that precede any rate decision, studying employment data, reading inflation reports, listening to banks describe credit conditions. These conversations form the hidden foundation beneath every headline that announces a rate hike or cut. Here, in this stillness, you begin to sense the paradox of central banking. Its actions feel abstract, almost invisible, yet they shape the living world in tangible ways. They influence whether a family can afford a new home, whether a business can take a chance on growth, and whether prices remain steady enough for people to plan their lives without worry. Tonight, we will move slowly, letting each idea unfold like a quiet page turning, learning how the modern world is gently steered by hands most people never see. As we wander farther into the quiet building, you come to a small reading room where shelves line the walls, filled with old ledgers and notes from decades past. Their spines are faded, but each one holds traces of the same question that echoes through every era. What exactly is money? It feels so familiar that most people rarely stop to consider it, yet its meaning rests on something surprisingly delicate. You sit at a wooden table, running your fingers along its smooth surface, and allow the idea to settle. Money, in its essence, is a shared agreement, a promise that something offered today will be accepted tomorrow. Economists describe it as a medium of exchange, a unit of account, and a store of value. But these formal terms disguise a simpler truth. Money works because people collectively believe it will work. It is a quiet form of trust that spreads across communities, across borders, and across generations, binding countless daily choices together. You open one of the old ledgers, its pages soft and slightly yellowed. Inside you see numbers carefully written next to dates and trades. Flour delivered, cloth returned, coins transferred. Long ago, physical money was made of metal or paper, something you could hold, something that felt weighty in the hand. But as you look around this dim room, you sense how far the idea has traveled. Most money today is not physical at all. It lives as entries in digital ledgers, shifting quietly between accounts, appearing and disappearing with each payment or loan. You imagine these entries as small lights across a wide landscape, glowing brighter as activity rises and dimming as it slows. When a person buys groceries, pays rent, or saves for a future goal, these tiny lights flicker in response, always adding up to the broader rhythm of an economy. The central bank oversees this landscape, ensuring the lights glow steadily rather than burning too hot or fading too low. Stability is not an exciting pursuit, but in the world of money, calmness is a form of safety. Even here, in this peaceful room, you can feel the subtle tension between what money is and what it represents. It is both simple and complex, both ordinary and immense. Without it, daily life would lose its smoothness, for barter alone cannot support a modern society. Yet with it comes the challenge of balance. Too much money flowing too quickly can lift prices and erode purchasing power, while too little can slow growth and reduce opportunity. You close the ledger gently, hearing the faint whisper of paper settling. Understanding money begins with this quiet recognition of trust, of shared belief, of countless small records that form the heartbeat of commerce. And as we move on tonight, we will follow how this trust expands through the actions of banks and the guidance of central banks, shaping the currents that move through every corner of the modern world. You leave the reading room and continue down a narrower corridor where a door stands slightly open, revealing a space filled with quiet screens and gentle light. It is here that the idea of money becomes more than trust alone, for the modern world relies not just on central banks, but on the countless commercial banks that surround them. You step inside and feel the hum of servers beneath the floor, a soft reminder of how money moves today. At first glance, it seems counterintuitive that banks can create money, yet this creation unfolds without fanfare. When a bank issues a loan, no physical pile of notes is handed over from a vault. Instead, a new deposit appears in the borrower's account, recorded as an asset for the bank and a liability for the customer. In that moment, the total amount of money in the economy gently expands. It is as though a small new lantern has been lit across the landscape we imagined earlier. One more glow added to the tapestry of activity. You picture these lanterns multiplying as families take mortgages, as businesses borrow to grow, as students finance their education. Each loan is a promise. The borrower receives purchasing power today, and the bank trusts that the loan will be repaid over time. This trust becomes part of the broader money supply, woven together across millions of decisions. The central bank does not directly create most of this money. Rather, it guides the conditions under which banks lend. Through interest rates, capital requirements, and access to reserves, it shapes the environment in which these lanterns brighten or fade. You pause beside a desk where a stack of forms lies neatly arranged. The language is technical, yet the underlying story is simple. When banks feel confident, they lend more. When uncertainty rises, they lend less. And because lending is the engine of money creation, changes in sentiment ripple outward. Even a small shift in credit conditions can slow or accelerate the flow of economic life. As you stand in this room, the connection between central banks and commercial banks becomes clearer, like two currents blending into one steady stream. The central bank does not control every lantern in the landscape, but it gently influences how bright the field becomes. By steering short-term interest rates, it encourages or discourages lending, subtly adjusting the rhythm of spending, saving, and investment. You step back into the hall, carrying with you the image of an economy as a field of lights, each one glowing because countless individuals decided to borrow, lend, or save. And you begin to see how the central bank's tools, though quiet and often unseen, set the conditions for how these choices unfold. Farther down the corridor, you find yourself drawn toward a conference room where the chairs sit arranged in a careful circle. Papers rest at each seat, and a muted screen displays charts showing inflation, growth, and employment. Though the room is empty tonight, you can almost sense the slow, thoughtful discussions that usually take place here. This is where the central bank's steering wheel truly turns. The setting of the policy interest rate. You sit at one of the chairs and imagine the faint rustle of documents as policymakers gather. They review vast collections of data, looking for patterns that are rarely obvious at first glance. Inflation moving slightly above target, unemployment drifting downward or upward, wages rising too quickly or not quickly enough. Each detail contributes to the final decision. And despite the complexity of the models and forecasts, the goal remains beautifully simple. Keep the economy balanced so people can plan their lives with confidence. The policy rate itself is a benchmark, a quiet signal to every bank in the country. When the central bank raises this rate, borrowing becomes more expensive, making loans slightly less attractive, while saving becomes a bit more rewarding. When it lowers the rate, the opposite occurs. Credit flows more easily, investment becomes more appealing, and spending gains momentum. These adjustments do not force behavior, but they gently tilt the landscape. You picture the process like adjusting the sails of a ship on a calm sea. A small change in angle alters the vessel's direction over time, not abruptly, but gradually, shaping the path ahead. In the same way, a shift of just 0.25% in the policy rate can gently alter the decisions of millions, though most may never consciously notice. This subtle influence is why interest rates are often called the economy's price of money. As you sit in the dim glow of the room, you feel the weight of how carefully these choices are made. Monetary policy is not about perfection, but about balance, about moving the economy toward conditions that support employment while keeping inflation steady. Policymakers know their decisions ripple outward, carrying consequences that unfold slowly across households and businesses. Eventually, you rise and leave the conference room, noticing how still everything feels. The charts remain on the screen, silent and waiting. And you walk with a clearer sense of how the central bank steers the vast, interconnected world of finance with adjustments so small they are measured in basis points, yet powerful enough to guide the flow of an entire economy. As you continue your quiet walk, you enter a long gallery overlooking the city, where the lights below shimmer like clusters of stars. Standing here, you sense how a single rate decision begins its journey outward, moving from the central bank's meeting room into the hands of commercial banks, and then into the everyday choices of millions. The process is slow and layered, much like ripples spreading across a still lake. The first ripple touches the banking system itself. Commercial banks borrow short-term funds from one another and, when needed, from the central bank. Their cost of obtaining these funds is directly shaped by the policy rate. If that rate rises, banks must pay more to access liquidity, and they pass this cost along through higher interest rates on mortgages, business loans, and credit lines. If the rate falls, funding becomes cheaper, and banks extend that ease to borrowers. It is a chain reaction, factual and predictable in theory, though softened by market conditions and sentiment. You imagine these changes traveling outward in gentle waves. A family considering a mortgage feels the first faint shift as monthly payments rise or fall by a small amount. A business thinking about expanding runs new calculations, gauging whether a project still makes sense at a higher cost of capital. Investors measure risk differently, adjusting portfolios, tilting more toward bonds when returns rise, leaning toward equities when yields fall. Each reaction is subtle on its own, but together they form a broad movement that can warm or cool an entire economy. Leaning against the window rail, you watch the city's rhythm below. Restaurants closing, buses humming, office towers dimming their lights. In these everyday scenes, the influence of monetary policy hides quietly. A cafe owner deciding whether to renovate, a young couple saving for a home, a student choosing between universities, all are shaped in part by the gentle push of interest rates. Yet none of them felt the meeting or heard the deliberations. They only sense the results through the prices they pay and the opportunities available. This is the quiet power of the central bank's hand. It does not command activity, but nudges it, guiding the balance between spending and saving, risk and caution, expansion and restraint. The transmission of policy is never immediate, and it rarely follows a perfect script. But over weeks and months, the effects settle into the rhythm of life, just as evening settles over the city below. You take one last look at the lights, then continue onward, ready to follow the next ripple as it moves deeper into the fabric of households, businesses, and markets, shaping the world in ways both subtle and profound. You step away from the tall windows and follow a staircase that curves downward, leading into a quieter wing of the building. The air here carries a gentle stillness, as though the movement of the outside world has slowed to match the thoughtful rhythm of the central bank itself. Along the hallway, a series of displays show charts of lending rates, credit spreads, and deposit flows. They glow faintly in the dim light, like constellations arranged in patterns only experts can fully read. This gallery tells the story of how the central bank's decisions enter the bloodstream of the financial system. When the policy rate shifts, banks respond because their own funding costs change. If borrowing short-term money becomes more expensive, banks adjust the prices of their loans to preserve margins and manage risk. These adjustments are not emotional or dramatic. They are procedural, almost automatic, rooted in balance sheets and regulatory frameworks. You imagine the banking system as a network of quiet canals, each one carrying liquidity from place to place. When the tide rises at the central bank, the water level in each canal lifts a little, making it slightly harder for boats to pass. When the tide falls, the paths open more freely, allowing movement with less resistance. In reality, these canals are interbank lending markets, repo agreements, and reserve corridors. But the effect is much the same. Liquidity flows more easily or more cautiously, depending on the central bank's signals. A soft hum fills the air from monitors nearby. They display the daily pulse of transactions, loans issued, deposits shifted, bonds purchased. Even though most people never see these flows, they determine how readily households and businesses can access credit. When conditions tighten, loan officers exercise more caution, and approvals become less frequent. When conditions ease, credit expands, supporting investment and consumption. You pause beside a panel describing reserve requirements. Banks must hold a portion of their deposits as reserves, either in cash or in accounts at the central bank. These reserves anchor stability, ensuring that banks can meet withdrawals and manage payments. While modern systems often rely more on interest rate corridors than strict reserve ratios, the principle remains. The central bank sets the tone, and banks respond in ways that ultimately shape the supply of money available to the public. Standing here, you feel the quiet precision of the system, the way it adjusts, not through commands, but through incentives. Each bank reacts to shifting costs, market expectations, and regulatory guidelines, creating a collective motion that gently aligns with the central bank's intentions. And so the ripples continue, moving from the deep channels of finance toward the everyday currents of life, where their effects will become clearer. You continue down the hall until you reach a room with large wooden blinds partially open, allowing a wash of evening light to spill across a table covered with folders labeled housing, mortgages, and household finance. The shift in focus feels natural, for once the banking system adjusts to new rates, the influence soon reaches the places where people make some of their most personal decisions. Mortgages are among the clearest ways interest rates touch everyday life. When the central bank raises its policy rate, the higher funding costs prompt banks to increase mortgage rates. Even a modest uptick can change the equation for a family considering a home. Monthly payments rise, borrowing capacity falls slightly, and decisions that once felt straightforward become more carefully weighed. When rates fall, the opposite happens. Refinancing becomes attractive, demand strengthens, and the housing market gradually warms. You imagine a young couple sitting at a kitchen table late into the evening. Papers are spread out. Calculators rest beside half-empty cups of tea, and the soft murmur of conversation drifts across the room. They are not thinking about the central bank or its meeting minutes, yet their world has been touched by decisions made far away. A small increase in the cost of borrowing may gently delay their plans, while a decrease may open a door they once thought closed. Still, the connection is rarely instant. The housing market moves slowly, shifting like a long tide influenced by local supply, wages, and household confidence. A rate change can take months to fully filter into home prices and construction trends. Builders respond to financing costs, landlords adjust rents, buyers alter their expectations. The effects compound, weaving themselves into the broader rhythm of the economy. On the wall near you hangs a map showing mortgage penetration across regions, dotted with subtle variations. In communities with higher exposure to variable rate mortgages, changes in policy transmit more quickly. In places dominated by fixed-rate products, the adjustment may take years, waiting for refinancing cycles or new borrowing. These structural differences shape how powerfully monetary policy reaches households. You close the blinds gently, letting the last glow of daylight soften around you. The influence on mortgages is only one part of the story, but it is a meaningful one, for housing is woven into the emotional fabric of life. As you move onward, you begin to sense how the central bank's quiet hand aligns with the hopes, worries, and plans of millions, guiding them in ways they often never see. Farther along the hallway, you find a small alcove where folders on business lending and corporate finance rest neatly in stacked piles. The lighting here is softer, as though meant to mirror the reflective decisions business owners face each day. You step closer and notice charts showing investment rates, borrowing costs, and corporate balance sheets. Businesses, like households, feel the effects of interest rates through the cost of borrowing. When the central bank raises its policy rate, banks respond by increasing rates on loans to firms. This influences decisions about hiring, expansion, and long-term investment. A project that once seemed profitable at a lower cost of capital may become less attractive when financing costs rise. Conversely, a lower interest rate environment encourages firms to take on new ventures, upgrade equipment, or expand operations. You imagine a small manufacturing company discussing its next steps around a conference table. The owner considers whether to purchase a new machine while the finance manager reviews loan options. In the background, the central bank's decisions quietly shape the terms they face. The company does not feel commanded, only guided by the gentle shift in financial conditions. Beyond the individual firm, these changes accumulate into national trends. Higher rates can slow business investment, easing pressure on prices and cooling demand. Lower rates stimulate economic activity, supporting job creation and encouraging innovation. Policymakers monitor these patterns, aware that the business sector plays a central role in economic growth. You take a moment to breathe in the stillness, noticing how softly the lines between the factual and the personal blur. Behind every chart is a story of people trying to build something. A cafe expanding its kitchen, a tech startup hiring engineers, a logistics company adding trucks. Their calculations hinge on numbers influenced by distant monetary decisions, yet the emotions behind them are deeply human. Ambition, caution, hope. You glance at a poster describing credit spreads, showing how lenders adjust risk premiums depending on economic conditions. When uncertainty rises, spreads widen, making borrowing more expensive even without a formal rate change. This illustrates how expectations and sentiment can amplify or soften the central bank's influence, creating layers of response that shape how firms navigate the future. Leaving the alcove, you carry with you a clearer understanding of how deeply interest rates are woven into the pulse of business life, guiding choices that ripple outward into employment, production, and the steady movement of the economy. A few steps farther, you arrive at a quiet chamber where employment statistics, wage charts, and labor market reports sit illuminated beneath soft lamps. This room feels especially serene, as though it holds the heartbeat of the entire economy. Employment is where monetary policy meets daily life most visibly, even if the link often unfolds slowly and indirectly. The connection between interest rates and jobs begins with the choices made by firms. When borrowing becomes more expensive, companies may delay expansion, reduce hiring plans, or scale back on new projects. When rates fall, the path toward growth feels more open, encouraging investment and job creation. These shifts can take months to appear in employment data, moving gently like the changing of a season. You picture a manager standing before a whiteboard late in the evening, reviewing budgets for the coming year. Perhaps the firm had hoped to add new positions, but higher financing costs have tightened margins. Or perhaps lower rates have improved cash flow, allowing the team to bring on new staff. These decisions, made one by one in quiet rooms across the country, accumulate into broader labor trends. Inflation also plays a role here. Central banks aim for stable prices partly because unpredictable inflation can erode wages and complicate hiring decisions. When inflation rises too quickly, real wages may fall, reducing purchasing power and straining households. When inflation is steady and predictable, workers and firms can negotiate wages with greater confidence. This stability supports employment and helps maintain a healthy economic rhythm. You study a chart showing the natural rate of unemployment, the level at which the labor market is balanced, not overheated, not stagnant. Central banks do not target unemployment directly, but they monitor it closely, using interest rates to help steer the economy toward conditions in which jobs grow sustainably. Too much stimulus can push unemployment too low, creating wage pressures. Too little can leave people without opportunities. The task is to maintain equilibrium. As you stand in this quiet chamber, you sense how profoundly monetary policy influences working lives. Even though few people ever trace their employment conditions back to the central bank. Each job created or lost is part of a larger story shaped by gentle adjustments to interest rates, flowing through businesses, wages, and demand. And so the ripples continue outward, touching every corner of the economy with a subtle but steady hand. You now follow a soft-carpeted path into a room where charts of prices, costs, and inflation expectations form a mosaic across the walls. The atmosphere here feels almost contemplative, for inflation is both a technical measure and a lived experience. It shapes how people feel about their future, their savings, and their purchasing power. And for central banks, it is one of the most important signals to guide their decisions. Inflation measures how quickly prices rise over time. A gentle rise is natural in a growing economy, allowing wages and profits to increase steadily. But if prices rise too fast, households struggle to keep up and money loses its value more quickly. If prices rise too slowly or even fall, economic activity can stall as people delay purchases and firms pull back investment. Central banks aim for a balanced path, often around 2%, where prices move predictably and confidence remains strong. You step closer to a display that simulates the passage of inflation over decades. As you adjust a dial, you see how small differences in inflation compound gently year after year, shaping the real value of savings, pensions, and wages. The math is simple, yet the emotional impact is profound. A world with stable prices feels reassuring. A world with volatile prices feels uncertain. Central banks influence inflation primarily through interest rates. Higher rates cool spending and borrowing, easing pressure on prices. Lower rates encourage activity, supporting growth when inflation is too low. These effects unfold slowly, and policymakers act with caution, knowing that missteps can push the economy out of balance. Expectations also matter deeply. If people believe inflation will be stable, their behavior reinforces that stability. If they fear rapid increases, inflation can accelerate simply because businesses and households act to protect themselves. You imagine a baker in a small shop deciding whether to raise the price of bread. She considers the cost of flour, energy, and wages, but she also looks at the broader sense of where prices are heading. Her decision, multiplied across millions of goods and services, forms the living fabric of inflation. That fabric is shaped by sentiment as much as data, stitched together by choices made quietly each day. As you leave the room, you feel a deeper appreciation for the delicate balance central banks strive to maintain. Inflation is not just a number, but the atmosphere in which all economic activity occurs. Keeping it calm and predictable allows the world to move with steady steps, supporting the quiet, persistent rhythm of daily life. You walk onward until the hallway widens into a circular chamber, its ceiling painted with sweeping patterns that resemble gentle ocean currents. The design feels fitting, for this room is dedicated to the mechanisms through which monetary policy spreads across the economy. Subtle channels that operate like interconnected tides. Screens curve around the walls, each showing a different dimension of the transmission process. Asset prices, credit conditions, exchange rates, and expectations. The first screen shows the bond market. When the central bank adjusts its policy rate, yields on government bonds often shift as well. Higher rates usually lift yields, making bonds more attractive and cooling demand for riskier assets. Lower rates depress yields, nudging investors toward equities, real estate, or corporate debt. These portfolio shifts influence how easily firms can raise capital and how markets value future earnings. Nothing here moves with drama. It is all a quiet rebalancing of preferences. Next, you notice a screen showing exchange rates. A country with higher interest rates often attracts foreign investment seeking better returns, causing its currency to appreciate. A lower rate environment may reduce this demand, allowing the currency to soften. These changes affect exports, imports, and competitiveness, touching industries and workers who might never think about monetary policy at all. Yet their daily realities shift as exchange rates glide up or down. Another screen shows credit spreads, the difference between the rates charged on safe assets and riskier ones. When policy tightens, these spreads often widen, reflecting greater caution among lenders. When policy eases, spreads narrow as risk appetite returns. These patterns determine how costly it is for businesses or households with different credit profiles to borrow. You pause before a final display that highlights expectations, perhaps the most delicate channel of all. People make decisions based not only on current rates, but also on what they believe will happen next. If firms expect future rate hikes, they may borrow sooner, accelerating investment. If households expect inflation to rise, they may adjust spending or wage demands. Expectations ripple through the economy like invisible waves, shaping outcomes before any policy action is taken. As you stand under the painted ceiling, the many channels begin to feel interconnected, like parts of the same quiet current. Monetary policy is not a single switch, but a flow that moves through markets, influencing choices, prices, and behaviors in layers. You sense the elegance of this system, its subtlety, and its reliance on both data and human perception. And with that understanding, you continue deeper into the building, ready to explore the tools through which central banks breathe in and out. Eventually, you arrive in a softly lit room filled with long shelves of reports labeled asset purchases, liquidity operations, and balance sheet tools. In the center stands a glass case holding a simple diagram of a central bank's balance sheet. This room feels quieter than the others, as though holding its breath, for here rests the story of quantitative easing, a tool often discussed loudly in the world outside, yet understood quietly here. Quantitative easing, or QE, is a way for a central bank to support the economy when lowering the policy rate is no longer enough. When rates are near zero and cannot be reduced much further, the bank can still stimulate activity by purchasing government bonds and sometimes other securities. These purchases increase demand for these assets, raising their prices and lowering their yields. Lower yields ripple outward, reducing borrowing costs and encouraging lending and investment. You imagine QE as a slow, warm tide entering a cool harbor. The water rises gently, lifting boats that had been resting near the bottom. In financial terms, liquidity expands as the central bank credits banks with new reserves in exchange for the bonds it buys. These reserves are not spent like ordinary money. They stay within the banking system, supporting lending and easing financial conditions. But their presence steadies the entire landscape, reassuring markets during uncertain times. Moving closer, you study a series of charts showing how QE operated during past periods of economic stress. The lines show yields falling, credit spreads narrowing, and market volatility easing. These effects do not promise immediate recovery, but they create an environment where households and businesses feel more confident to act. The central bank does not force optimism, it simply provides a safety net that invites it. You run your fingers lightly along the edge of the glass case. QE is not magic, nor is it limitless. It cannot solve structural challenges or guarantee growth, but it can support an economy when fear threatens to tighten every channel of credit. And so, when used carefully, it becomes a gentle breath of reassurance, reminding markets that stability is being tended to with steady hands. You take a final look around the room, noticing how even the air seems to move slowly. QE is a quiet tool, one that expands the central bank's presence without stirring panic or excitement, and soon you will explore its counterpart, the slow receding tide that restores balance when the storm has passed. A few doors down, you enter a room illuminated by cooler light, with shelves labeled balance sheet normalization and asset roll-offs. The atmosphere feels different here, still gentle, but with the sense of a slow exhale. This is the home of quantitative tightening, or QT, the process by which a central bank gradually unwinds the support it once provided. Quantitative tightening is the mirror image of QE. Instead of buying assets, the central bank allows bonds on its balance sheet to mature without replacing them, or in some cases, it sells a portion of them back into the market. As the central bank steps back, demand for these securities decreases, yields may rise, and financial conditions gently tighten. This shift encourages a more measured pace of borrowing and spending, guiding the economy back toward balanced growth. You picture QT as a tide slowly receding from the shore, revealing the contours of the landscape beneath. Nothing dramatic occurs. There is no sudden withdrawal, no jolt of cold air. The water simply lowers inch by inch, restoring the shoreline to its natural rhythm. Markets adjust, banks adapt, and borrowers recalibrate their decisions as conditions shift. On a nearby screen, animations show the central bank's balance sheet shrinking over time. You watch as lines that once expanded rapidly now slope downward in gentle arcs. The message is clear. Expansion and contraction are both part of the same cycle, tools used with care to maintain stability. QT does not act as a brake so much as it removes the extra warmth QE once provided, allowing the economy to move on its own strength. Next to the display stands a panel explaining how QT influences long-term interest rates. As the central bank reduces its holdings of government bonds, private investors must absorb a larger share of new issuance. This shift can raise yields modestly, nudging credit conditions toward a more neutral stance. The effects unfold gradually, giving markets time to adjust without strain. You close your eyes for a moment, feeling the symmetry between QE and QT, the inhaling and exhaling of a vast economic system. Each movement is deliberate, designed to encourage resilience and avoid extremes. And when you open your eyes again, the room's quiet blue light seems to echo this calm balance, preparing you for the deeper layers of how money circulates and settles within the economy. Leaving the QT chamber, you ascend a short flight of stairs and enter a spacious hall where translucent panels display the components of the money supply. The room has an airy feeling, as though inviting you to understand how all the pieces fit together beneath the surface. Here, The central bank's balance sheet, commercial bank deposits, and circulating currency blend into a single living system. The panels show the main forms of money: physical currency, deposits created by commercial banks, and reserves held at the central bank. Most modern money exists as deposits, created when banks issue loans. Reserves, by contrast, are held only by banks and are used to settle payments between them. When the central bank engages in QE, reserves rise. When QT occurs, they fall. Yet these reserves do not directly enter the hands of households. Instead, they influence how easily banks can lend. You watch animations showing the flow of reserves through the system. Payments swirl between banks like gentle streams, each settlement quietly adjusting the reserve balances. The central bank oversees this landscape, ensuring that liquidity remains sufficient so banks can meet their obligations and maintain trust with one another. Without this foundation, the entire system would strain under the weight of uncertainty. A nearby display highlights the money multiplier, a soft, simplified depiction of how initial reserves support a larger volume of deposits. The multiplier is not fixed. It depends on banks' willingness to lend and households' desire to borrow. When confidence is high, lending expands and the money supply grows. When caution rises, the expansion slows. These changes are not commanded from above. They emerge from the collective behavior of millions of people. You step toward a window overlooking the city once more. As you observe the lights shimmering below, you imagine the flow of money through daily life. Wages paid, groceries purchased, bills settled, savings set aside. Each transaction represents a small movement within the broader system. You now understand more deeply. Standing in this hall, you sense the central bank's role as a quiet architect of stability. It guides the money supply indirectly, shaping the environment in which deposits expand or contract. The system is delicate yet resilient, grounded in trust and supported by thoughtful stewardship. And as you turn away from the glowing panels, you feel a gentle clarity settling in, preparing you to explore how these monetary currents ripple far beyond a single nation's borders. As you continue your walk, you enter a long corridor lined with world maps and soft-lit displays showing currency movements across continents. The space feels open and global, reminding you that money does not stop at national borders. Decisions made in one central bank often drift outward, influencing economies oceans away. Here, the air carries a sense of quiet interconnectedness. A large map at the center shows how capital flows respond to interest rate differences. When one country raises its rates, investors may shift funds there in search of better returns. This movement strengthens the currency of the country with higher rates while gently weakening others. These adjustments affect exporters, importers, and travelers, shaping competitiveness and trade balances in ways that unfold gradually over months. You imagine a manufacturer in one country watching exchange rates as closely as production costs? A stronger home currency may make exports more expensive abroad, softening demand. A weaker currency may boost sales but raise the price of imported materials. These real-world dynamics are influenced by global monetary currents that begin with the quiet decisions of policymakers far away. On another panel, you see the path of global financial conditions, a measure of credit costs, equity valuations, and risk appetite across major economies. When a large central bank like the Federal Reserve tightens policy, global financial conditions often tighten as well, even in countries that do not change their own rates. Investors become more cautious. Borrowing costs rise and vulnerabilities in emerging markets can surface. These effects are not deliberate. They are the natural consequence of deep financial interconnection. You walk slowly along the corridor, noticing a display dedicated to spillover effects. It explains how monetary policy in one region can influence inflation, growth, and asset prices elsewhere. Countries with flexible exchange rates adjust through currency movements, while those with fixed or managed systems may need to follow the foreign central bank's actions to maintain stability. The web of influence spans continents, connecting distant economies through channels of trade and finance. As you pause before a final map, the lights dim slightly, creating a moment of reflection. The global system feels vast, yet its movements are governed by simple principles. Capital seeks return, currencies respond to flows, and confidence travels across borders as easily as information. You sense how the quiet deliberations in a single meeting room can shape the world's economic weather, gently guiding the currents that link countries together. You follow the corridor until it opens into a quiet observatory-like room where curved screens display shifting patterns of market behavior. Lines drift gently across them, showing interest rate futures, volatility indices, and sentiment surveys. This room feels different from the others, more introspective, for it reminds you that monetary policy does not influence only numbers and transactions. It also shapes the collective mood that guides financial decisions. Expectations, sentiment, and psychology are subtle forces, but they often determine how powerfully policy moves through the economy. When a central bank signals it may raise rates, markets may respond even before any action is taken. Investors reprice assets in anticipation. Banks adjust their lending posture, and households reconsider major purchases. These early responses can either amplify or soften the eventual impact of the formal rate change. You imagine these expectations like a faint breeze moving ahead of a weather front. The air shifts before the clouds arrive, alerting anyone who pays attention that a new pattern is on its way. Similarly, when policymakers provide forward guidance, explaining how they expect to act in the future, they gently nudge behavior today. If they signal a long period of low rates, businesses may feel confident to borrow and invest. If they convey caution, markets may slow their pace. A display nearby shows how quickly financial markets react to central bank communication. Bond yields adjust within minutes, stock markets shift direction, and exchange rates reflect new expectations almost instantly. Yet, it is not only traders who respond. A household might hear on the evening news that rates are expected to rise and choose to accelerate a home purchase. A company may delay issuing debt until markets settle. These reactions ripple outward, influencing the real economy long before the policy takes effect. You move toward a quieter corner where sentiment indicators glow softly. Confidence surveys capture how households and firms feel about the future, whether they are optimistic, uncertain, or fearful. Central banks watch these measures closely, for confidence can either support stability or undermine it. When people trust that inflation will stay contained, their decisions reinforce that stability. But when doubt spreads, even small worries can escalate into larger imbalances. Standing in this observatory, you sense how the economy is not only a system of numbers, but also a story millions of people tell themselves each day. Monetary policy guides that story with careful words and steady intentions, calming the currents when they grow turbulent and encouraging resilience when the horizon appears uncertain. And with this understanding, you continue onward, ready to explore why even the smallest adjustments, mere basis points, can shape the world. You enter a softly lit passageway lined with delicate instruments, almost like an old scientific workshop. Rulers, scales, and lenses rest on wooden shelves, each labeled with tiny brass plates. It is a symbolic space, reminding you of the precision with which central banks work. Here, you sense the importance of small changes, adjustments so modest they are measured in basis points, yet powerful enough to steer an entire economic landscape. A basis point is 1/100th of a percentage point, a tiny unit that might seem insignificant in daily life. But in financial systems where trillions of dollars move, even a few basis points can shift the balance of borrowing and lending. For a bank financing large portfolios, a 5 or 10 basis point change affects profitability. For governments, it influences the cost of issuing bonds. For households, these small increments shape mortgage payments, loan affordability, and savings returns. You imagine these tiny adjustments as gentle taps on the rudder of a massive ship. The movement is almost invisible at first, yet over time the vessel shifts course, heading toward calmer waters or away from potential storms. Monetary policy works in much the same way. A small rate increase cools demand just enough to ease inflationary pressure. A small decrease supports growth without fueling excesses. Precision matters more than force. Near you stands a long glass case showing historical rate changes. Some of the most significant economic outcomes were shaped by adjustments so small they barely caught public attention. Financial markets noticed, analysts discussed them, and gradually households began to feel their effects. Over months and years, these tiny steps shaped employment trends, investment cycles, and inflation paths. The central bank's craft is not to shock the system, but to guide it with steady, measured hands. You reflect on how these delicate choices protect stability. Large, abrupt changes could disrupt markets or unsettle confidence. Small shifts allow the economy to adapt gradually, giving firms and households time to adjust their decisions. This is why central banks often emphasize gradualism, the belief that slow, careful movements foster better outcomes than sudden jolts. As you walk farther, the instruments around you seem to blur softly, their contours merging into a sense of calm control. Basis points may be tiny, but they carry the weight of intention. They reflect a philosophy rooted in patience, balance, and foresight. And as you approach the next room, you sense the narrative returning toward its beginning, ready to gather all these threads of money, psychology, and policy into a final, gentle reflection. You return to the upper floors of the building, where the lights dim further and the rooms grow quieter, as though guiding you gently toward a conclusion. Here, the displays show simplified diagrams, not the technical charts of earlier rooms, but soft outlines summarizing the journey of monetary policy from decision to impact. The air feels warm, almost nostalgic, inviting you to gather the understanding you've collected along the way. You see the sequence unfold. The central bank sets a rate. Banks adjust their funding costs. Households and businesses respond to new lending conditions. Markets shift portfolios. Inflation and employment move slowly in reaction. It is a chain of influence, each link connected not by force, but by incentives and expectations. The system behaves less like a machine and more like an ecosystem, responding organically to changes in its environment. A nearby panel highlights the time it takes for policy to have its full effect, often many months, sometimes years. This delay, known as the transmission lag, is why policymakers look ahead, basing decisions on where they believe the economy is going rather than where it stands today. They must anticipate the future, adjusting the sails before the winds change. You imagine the experience of those policymakers sitting around their long table late into the evening. They study data, but they also listen to stories, reports from businesses, from workers, from bankers on the front lines of credit markets. The economy is not a single number, but a mosaic of lives woven together by countless human choices. Monetary policy aims to support these lives by maintaining a foundation of stability on which people can build their plans. As you continue through the room, you notice a gentle animation showing the goals of policy: low and stable inflation, sustainable employment, financial stability. These objectives do not require perfection. They require balance. Too much heat in the economy can erode purchasing power. Too little energy can stifle opportunity. The central bank moves between these risks with quiet care, adjusting its tools as conditions evolve. You pause at a window where moonlight spills across the floor. Outside, the city moves at its own pace, taxis passing, lights flickering, people returning home. All of them feel the influence of the decisions made here, even if they never think of interest rates or balance sheets. Their choices, combined, become the heartbeat of the economy. And you sense now how gently the central bank tries to guide that heartbeat toward steadiness and calm. Near the end of your journey, you arrive at a long corridor that feels familiar, almost like the one you entered when the night began. The lamps glow softly, casting warm pools of light along the polished floor. You walk slowly, feeling the weight of the building's quiet purpose, not to control the economy, but to steady it, to create an environment where people can plan, work, and dream without the fear of sudden instability. You pause beside a tall bookshelf where documents sit neatly in rows. They chronicle decades of decisions, moments when rates were raised to cool inflation, times when rates were lowered to support growth, years when QE helped restore confidence, and periods when QT gently normalized conditions. Each entry tells a story of balancing risks, responding to new information, and adjusting policies to preserve stability. No decision was perfect, yet each represented an effort to guide the economy through changing tides. As you walk farther, you pass a set of windows overlooking the city once more. This time, the streets feel quieter, the night deeper. You imagine the many people now sleeping in the homes below. Families, workers, students, business owners, all living lives subtly shaped by the ripples of monetary policy. They may never think about policy rates or reserve balances, yet their opportunities, costs, and choices are gently influenced by them. You reflect on the paradox you sensed earlier. The central bank's impact is both invisible and immense, both soft and structural. It works through incentives rather than mandates, through expectations rather than commands. Its effectiveness relies not on force, but on credibility, a belief shared across society that the institution will respond thoughtfully when conditions change. The corridor narrows slightly as you continue toward the final room. Here, framed messages from past policymakers line the walls, each expressing variations of the same idea, that monetary policy is, at its heart, a tool for supporting people's well-being, not by directing their decisions, but by securing a stable environment in which those decisions can flourish. As you near the final turn, you feel the story gathering its threads. Money as trust, lending as creation, interest rates as gentle guidance, QE and QT as tides, global spillovers as quiet currents, and expectations as the invisible wind. All of it leads you toward a final peaceful reflection waiting just ahead. You step into the final chamber, a quiet circular room lit only by a single lamp on a central table. Its warm glow pools softly around a few open books, and a clock ticking in slow, steady beats. The air feels hushed, as though inviting you to sit for a moment and let the night settle gently around you. You take a seat, breathing in the calm, and reflect on the journey you have made through these silent halls. From the first soft steps along the marble floors to this last quiet room, you have witnessed how the economy moves not through sudden forces, but through gradual, deliberate shifts. Money begins as trust. Banks expand it through lending. Interest rates guide its flow. Policy decisions ripple outward into mortgages, into business plans, into job markets, and into the ebb and flow of inflation. Even the smallest adjustments, measured in basis points, shape the world's rhythm with delicate influence. You recall the warm tide of quantitative easing, lifting financial conditions when storms arrived, and the cool, receding tide of quantitative tightening, restoring balance as calm returned. You remember the global maps, the shifting currencies, the markets that respond not only to actions, but to expectations, and the countless households touched by these movements, often without ever noticing. Sitting here now, you feel the gentle truth at the heart of it all. Central banks are caretakers of steadiness. Their tools are quiet, their influence subtle, and their purpose is simple: to help the world move with confidence, neither rushing forward nor slipping into uncertainty. They tend the economic landscape much like a gardener tends a vast field, pruning where needed, nourishing growth, and allowing seasons to unfold at their natural pace. Outside, the city continues its slow, peaceful pulse. Lights dim in distant windows, and the night air settles into its familiar silence. Whatever tomorrow brings, new decisions, new data, new challenges, the foundation remains steady. The invisible hand guiding money, rates, and expectations continues its quiet work, shaping the background of daily life with patience and care. You rise from the table, taking one last look at the lamp's warm glow, and step toward the doorway leading back into the stillness of the night. The halls fade behind you like a soft memory, leaving only calmness and the gentle rhythm of your breath. Good night.